Hey everybody, it's Jonathan. Today I'm going to show you a very simple trick or style of analysis in trading equity indices futures that I think will really help you going forward. So in front of you, S&Ps, and I'm on ThinkOrSwim. ES, you can see my charts are very clean, been trading for 18 years. The last thing I want on my charts is lots of lines. I want things very simple. I want to take a step back. I want to use common sense. So what I'm going to do, S&Ps, on ThinkOrSwim, if you just go and hit this cog right here, the setting box is going to pop up. What I want to do is you want to show price as a percentage. We want to show price as a percentage because we're going to do a relative value analysis. So instead of it just showing the price here, it's going to show us it's up 13% over this time frame. These are just basic 100 and 200 period moving averages. So when I'm looking at equity indices and I'm deciding on what trade that I want to do, too many people are looking to buy, sell, buy, sell, buy, sell. But what they're really doing is they're not allowing the market to move. Rather than that, what I want to do is look at things from a relative value standpoint. So S&Ps right now. For me, I'm extremely bearish the S&Ps. I'm bearish the S&Ps because the yield curve in the US is darn close to going inverted. The last 9 times, or the only 9 times the yield curve has gone inverted, 100% of the time that's predicted a recession. So unless the yield curve steepens a ton, I'm going to be very bearish on the US equity market. So here's what I'll do as far as analysis. For one, when looking for trade opportunity, I'm not willing to buy this because I'm bearish for the reasons that I just mentioned. But instead of just looking at the S&Ps, I want to look at other correlated indices. So if I hit the beaker here, and you can do this on any platform, I'll remove those moving averages. I'm going to scroll down, and then what I'm going to do is I'm going to compare. Comparison, add selected, and let's compare the S&P to the NASDAQ, NQ. You don't need it on the left axis, okay. And then let's also compare it to the Dow. Compare it to the Russell as well. Right now we're just going to do the NASDAQ and the Dow. I want you to see the correlation. I want you to see how these are going to push and pull off one another. Okay, apply, okay. Now the key in making sure that your charts are set up correctly is that obviously it needs to be on that percentage. And then it's going to go back to the starting point of the chart. So if I go and add more data to the chart, and let's say we go on a weekly, it's going to readjust. It's all going to have the same starting point, and then they're going to go and trade, and then they're going to break apart. They're going to come back together. So the pink is going to be the NASDAQ. The NASDAQ is strong, but the terminology that we use is nothing is ever strong. The NASDAQ is strong relative to the other indices. Then you have the S&Ps, and then you have the Dow. If I go back to a daily and look on a shorter term time frame, the Dow is going to be the green, the S&Ps are going to be the blue. Now if you go back and look at the historical behavior, what you'll notice is Dow gets expensive. NASDAQ gets expensive relative to the S&Ps. But look how it corrects itself. Comes back to a better semblance of value. When they break apart, look how they correct themselves. Right now, the NASDAQ is very expensive relative to the other two. So earlier I said I'm bearish S&Ps. I wouldn't buy the S&Ps, but being bearish S&Ps, it seems that rather than get short S&P futures, which one would do if they're bearish S&Ps and was a futures trader, what I want you to consider is forget that trade. Don't do that trade. Go short the NASDAQ because you're going to get better value. As you short the NASDAQ, many people and I teach a lot of different traders, many people have trouble or problems staying in a trade. They see a winner, they take it off real quick, they want to lock in profits. If you're able to short the NASDAQ, instead of just locking in a profit as it comes off, well, as the S&P comes off, you could buy the S&P. So now you're short the NASDAQ and long the S&P. It'll allow you to stay in the NASDAQ trade for longer than you might otherwise do, but you're also now trading the spread relationship. And the spread relationship is going to be the difference between the two contracts, the S&P and the NASDAQ, or the NASDAQ and the Dow. If I go back to the beaker and let's take off the Dow just so we can look at things in a simpler format, here's what it looks like going back on a daily to mid-2017. What I like to do, how I teach, and what I think is a great exercise for all futures traders is if you're looking to get short, if you share the view that I have that I'm bearish, I would only be selling the NASDAQ. I'd look to sell the NASDAQ on pops, on little rallies. That's when you can use your technical analysis, find some good entry points. If you have the opposing view and you're bullish the overall market, maybe you see us going into the summer, the VIX is really low, you're not too concerned with the yield curve, or maybe you don't follow it so closely. So if you're bullish, well, I wouldn't buy the NASDAQ. If you're bullish, consider buying the S&P. So what you can do is, instead of just buying and selling, buying and selling, buying and selling, you're only looking to sell NASDAQ and you're only looking to buy S&Ps. And by doing this, it's going to hold you accountable. It's going to make you really disciplined. Because if your view is the market's going down and you're only looking for places to sell the NASDAQ in this example, you're not going to chase. Maybe the NASDAQ goes higher while the S&P is going lower. That presents a great opportunity. Try this out. Everything that we do in life, every buying decision we make using some kind of relative value analysis. When you buy a home, when you buy a phone, it's all relative value. When you're trading, that needs to be relative value as well. Again, nothing's expensive, nothing's inexpensive, only if they're inexpensive or expensive relative to something else. And that something else obviously needs to be a highly correlated product, but it's a great way so you're not just trading one chart and trying to play a breakout or looking for little patterns. This will hold you accountable. Try it out. If you like it, leave a comment in the YouTube comment section. I'd love to hear it. If you have any questions, I'll make sure that I get back to each question, okay? Again, my name is Jonathan Rose, owner of Active Day Trader. I really appreciate you listening. Thanks, guys.